Hey, I'm RJ Polano from Buy Cash Flow Properties. Today we're going to talk about individual retirement accounts, that is IRAs, but specifically the major difference between a traditional IRA and a Roth IRA. Now, I know this is confusing to some people, but I've been doing this a long time and it's actually quite simple. In each case, you can contribute $5,000 a year. Okay, $6,000 a year if you're over 50 years old. Those are what the government has labeled the catch-up provisions. But here's the big difference. In a traditional IRA, you're allowed to get a deduction off of your adjusted gross income in the year that you make the contribution. So a lot of people get caught up with getting this deduction thinking it's the greatest thing since peanut butter because they have less taxable income in that year. However, there's a price to be paid for that because at the time of distribution, which is 70 and a half years old, and with a traditional IRA at 70 and a half, you have got to take distributions mandated by the government based on the amount of money that's in your account as well as your life expectancy. This is not the case with the Roth IRA. With the Roth IRA, you never have to take distributions, but you can take them beginning at age 59 and a half as long as you've had the account for 5 years. The big thing is this, it's not the having to take the distributions or not, but with a Roth IRA, there is no income taxes at the time you take the money out. As I'm writing this, or as I'm reading this to you, or as I'm not reading or writing, as I'm talking to you, I'm 61. I could take out my money right now, but why would I? I have other income and money that I live off of. I just leave it in there and it continues to compound and compound and compound. And whenever, if ever I need it, I then can take it out. But I'm not going to do it now. I'm going to just let it continue to roll. And I think in the case of most investors, they miss this big point because you can convert your traditional to a Roth IRA, which I did the first year that it was available, and I did it when it wasn't worth a lot of money. You don't want to do it when it's worth a lot more, because if you do it when it's worth a lot more, then you're going to pay a lot more income tax. So the time to do it is on the front side. And then the big challenge for most of you will be to find good opportunities to put in there. The key is to never lose money in your IRA no matter what, because once you lose that money, if it's a Roth, you've already paid income tax on it. Nothing would be worse than losing money that you paid income tax on. So it's important to find yourself opportunities that you know are going to work out, that are going to give you a predictable income so that at the time of your retirement you can enjoy a lifestyle that you've earned and deserve for all the years that you have worked. As always, contact us at any time if you have any questions on this. Wanted to keep it simple and short. There you go. The next series is going to be on 401ks.